Ever feel like you're looking at trading through a keyhole?
Yeah, like you're only getting a sliver of the picture.
Exactly. We
Mm.
totally get it. Sometimes you just want the core differences, stocks versus options laid out simply.
So you can figure out what might be a good fit for you.
Right. And that's exactly what we're going to try and do today. Break down what really sets stock trading apart from options trading.
Think of it as a quick guide.
Yeah, a guide to seeing how options can offer a whole different set of tools, especially compared to just buying and selling stocks, particularly if you're, well, just starting out.
Exploring the world of trading, yeah.
Now, as some of you know, we're experienced options traders over at AdvancedAutoTrades.com.
And we've seen firsthand the unique power of options, definitely.
So our goal today is pretty straightforward. We want to give you a clear understanding of the main things that make options different.
And for us, I think you said it boils down to two key ideas.
Yeah, exactly. Leverage and the sheer number of choices you have. Those are the big ones.
That's a great way to put it. Stocks are often, the starting point for a lot of people.
The default, almost.
Right. You buy a piece of a company, hope its value goes up, sell it higher. Seems
simple. On the surface, yeah.
But what's fascinating when you start looking at options is how they give you a completely different way to interact with that same company, that same stock.
Okay, let's jump into leverage then. Now, I know when some people hear leverage, maybe some alarm bells go off.
Yeah, I understand why. It gets a bad rap sometimes.
It does. And look, if it's not used carefully, it can definitely increase risk. No doubt about that. But the way options provide leverage, it can actually be about potentially boosting your returns while maybe putting less capital on the line compared to buying the stock outright, I mean.
Precisely. Let's think about the capital involved, maybe an example.
Good idea.
Imagine a stock trading at, say, $100 a share. To control 100 shares, what do you need?
100 times 100, $10,000.
$10,000. And your potential profit is tied to the percentage gain on that 10 grand.
Makes sense.
Now, with options. For a much smaller amount, maybe a few $100, that's the premium you pay. You could potentially control those same 100 shares.
For a specific time, though.
Yes, for a specific period. And if the stock moves your way, well, your percentage gain on that much smaller initial investment, it can be significantly larger.
Okay, so that's the potential upside of leverage.
But what's fascinating, as you mentioned, is that the option has an expiration date. That adds a whole time element that just isn't there when you simply hold a stock, right?
Right. And that time element is crucial. But let's get to the other part, the thing that gets really interesting for me, the choices, the sheer variety you get with options.
Yeah, that's huge.
With stocks, like we said, it's mostly buy if you think it goes up.
Or short if you think it goes down.
Right. Betting it will fall. Pretty straightforward, directionally speaking. But options, man, they open up a whole menu of strategies.
And that's the power, isn't it? The flexibility they offer based on what you think might happen.
Exactly. It's not just a simple up or down bet anymore.
You can build strategies around, well, maybe you think the stock will just stay flat or within a certain range.
Or if you think it's going to get really volatile or maybe less volatile.
Or even how fast you think a price change might happen. There are strategies for all of that.
Okay, let's use that $100 stock example again.
Sure.
With the stock, you buy hoping for $101, $105, whatever, or short it hoping for $95, $90. That's kind of it.
Pretty much.
But with options, well, you could buy a call option, maybe with a strike price of $105 if you think it's really going to climb.
And that call gives you the right, not the obligation. Important distinction.
Yes. The right to buy the stock at that $105 strike price before the option expires.
And this is where it gets really interesting.
Yeah, this is what I find really powerful. You could set up a strategy that actually makes money if the stock just bounces around. Stays between, say, $90 and $110 for the next month.
You don't even need to be right about the direction. Up or down doesn't matter as much in that case.
Exactly, just that it stays in the range. That blows my mind compared to just buying stock.
And this brings up a really important question for anyone starting out, doesn't it? What's your actual belief about the stock?
Right. What are you really predicting?
With stocks, your profit is pretty much directly tied to getting the direction right, up or down.
Mm-hmm.
With options, you can actually profit even if you're, wrong about the specific direction, as long as your broader prediction about its movement or lack of movement plays out within that set time frame.
And that brings us back again to those expiration dates, that time factor.
Crucial point.
Unlike buying a stock and holding it, maybe for years, options have a limited lifespan. They expire.
Which forces a decision. Or at least factors time into your trade plan.
Yeah, it introduces that time decay element. But hey, that's also part of what makes the leverage and these different strategies possible, isn't it?
Absolutely. You're essentially making a calculated bet on something happening or not happening within a defined period.
A calculated bet. I like that.
And if we connect this back to risk for a second,
Yeah.
while the leverage in options can magnify gains, it also means if you're wrong, if the option expires, worthless.
Your loss is capped.
Exactly. Your potential loss is limited only to the premium you paid initially, that few $100 in our example.
Which is a key difference from owning the stock, right? Where, okay, theoretically the risk is down to zero.
Right. The stock price going to zero is your max loss on a long stock position.
Yeah.
But with options, you know your max loss up front when you buy the option. It's just the premium paid.
So, okay, let's try and tie this together for someone just starting their trading journey. Understanding this fundamental difference is really key, isn't it?
Definitely.
The mostly directional bet of stock trading versus the more multifaceted possibilities of options.
It's not about one being inherently better or worse.
No, not at all. They're just different tools for different jobs, different market views, different trading styles.
And maybe think about the bigger picture, too. Options can be, well, quite attractive for traders who maybe have smaller accounts.
Ah, good point. Accessibility.
Yeah, because they let you potentially control a larger number of shares with less capital than buying the stock outright.
Like we said with the $10,000 versus a few $100 example.
Exactly. It can open up trading opportunities that might just be too expensive if you had to buy the shares directly. It's kind of like putting a small deposit down to control a much bigger asset.
Like earnest money on a house, maybe. Not quite a mortgage, but...
Sort of. A small initial outlay gives you exposure to the underlying asset's price movements.
Okay, so let's quickly recap those main takeaways then.
Good idea.
First, options offer leverage. Potential for bigger returns on your invested capital, maybe with less initial cash tied up.
And this is big, but you absolutely have to understand how to use that leverage responsibly. Misuse it, and it can amplify losses just as easily.
Crucial warning. Okay, second big point. Options give you more choices. Way more choices.
Right. You're not just stuck with buy hoping it goes up or short hoping it goes down.
You can use strategies that actually work in different market conditions, even if the stock price isn't making a huge move either way. Sideways markets, for instance.
And if we quickly contrast that again with stock trading, its limitations become clearer, right?
Yeah, primarily directional. You need the price to go your way. Up if you bought, down if you shorted.
And controlling a significant position, like a few hundred shares of an expensive stock, can tie up a lot of capital.
But with options, you've got this potential to profit in multiple scenarios.
Up, down, sideways, volatile, not volatile.
It just opens up the playbook, doesn't it? So as you think about navigating the market, maybe consider this. What if you could have more ways to potentially win, no matter which way the wind seems to be blowing?
That really gets to the core of what options can offer, doesn't it? That strategic flexibility.
It really does.
And look, there's definitely a lot more to explore here. Options have more moving parts than stocks.
Oh, for sure. Strike prices, expiration dates, implied volatility. Lots to learn.
But grasping these fundamental differences we talked about today, leverage and choice, that's really the essential first step, I think. Understand the basic contrast. If you enjoy this episode and want to stay ahead with fresh insights every other day, don't forget to hit that subscribe button or follow our podcast. We've got more exciting content coming your way, and we can't wait to have you back. See you soon.